As a community, your comments can genuinely influence this show and the content that I create. Today's episode was entirely inspired by YouTube user Mathematician1234. For our story, I'm going to share with you that conversation and exactly why the inspiration there within matters. And for our main topic today, we're going to be revisiting my retirement survival study results with a very important assumption change. And it's one that may very well actually impact your retirement strategy for the better. Good morning and welcome to the HopeFilled Financial Podcast. My name is Jay Disberger, your one and only HopeFilled Financial Coach, and I'm happy that you're here with us today. For today's story, I want to share a very impactful and valuable conversation that I had in the YouTube comments section. If you follow the podcast on YouTube, there's one video that's become significantly more popular than every other episode, every other breakout video that we've produced, and that's going to be me reacting to the call that I made to the Dave Ramsey show on November 2nd. And if you're listening to audio only, I'm going to paraphrase the initial comment that started this conversation and share the highlights that inspired the main topic. This particular comment basically started by laying out that Dave Ramsey and I use different sets of assumptions when it comes to our retirement modeling. And if we apply our respective assumptions, we get our own respective answers. So it's not that either one of us is bad at math. It's just we're solving problems with different assumptions.
And they're not using good sets of assumptions.
And I love this point that our assumptions were different, and that's why our results were different. The assumptions that go into the retirement modeling to come up with retirement strategies and retirement education truly do matter. So I responded, "You are a nerd after my own heart. Thank you for the comment." I would say the issue at play is the part you mentioned at the end. Dave assumes no volatility in his model, which yields a result that does not reflect reality. The study results should provide more realistic risks that we can use to understand potential and relative risk exposure given different approaches. I would and do argue that 8% safe withdrawal rates will expose almost anyone to undue risk when applied with the constant dollar method over an average retirement, assuming regular rebalancing and the like. I ran my own simulations as well, so I could best understand all of this. I posted that in episode number 36. I think you will like that one a lot. It is a lot of numbers, but the results for my set of assumptions are pretty cool. While I think episode 36 is genuinely helpful for everyone, it does really get into the weeds of a significant number of numbers. I'm not going to read all of this response verbatim from Mathematician1234, but I am going to read the bulk of it. Oh yes, I am a nerd. Thank you. Yes, understanding the risk is important for all of us. Once the market risk is injected into the simulation, it produces a sequence of returns risk, and that has the potential to be the killer of hopes and dreams. I think this is interesting since Dave Ramsey's big reason for using 8% safe withdrawal rates in his answers on the radio is to avoid hope stealing or killing hope. Moving on, this is the part of the conversation that inspired the main topic. An extra level of Monte Carlo modeling would be to allow for time-varying inflation. I have not done that yet. I am not sure how the random variables driving inflation and stock returns are correlated. That's a big deal. I could look that up and model it. It might help, or hurt, or be neutral. Best wishes and wishing you many happy returns. Okay, and this is something that while I've thought about, I did not necessarily apply in my initial retirement study, taking into account time-varied inflation. If the varied return of the securities you're invested in, be them equities, bonds, or whatever, goes up and down with time, and there's sequence of returns risk, well, certainly inflation has a sequence risk tied to it. And there may be a correlation under the efficient market hypothesis that when inflation is going up, returns may also follow and in some way act as a hedge against inflation, depending on what you're invested in. In other words, what you're invested in for your retirement has varying sensitivity to inflation and may be directly or inversely correlated to the changing inflation month to month. And there can also be a delay from inflation changing and then the investments reacting. Now, this got me thinking that modeling time-varied inflation relative to the historical data that I used for my study in episode 36 would be a good idea. So I responded, perhaps this is something you might enjoy playing with. You could simply use an inflation-adjusted return for the portfolio in question. The distribution wouldn't need to be modified year after year in that case, as growth is already converted into today's money. Do you think that would work? Also, in my work, I have distributions taken out at the monthly level to make the work more reflective of reality. I cannot practically imagine only taking out one withdrawal from the nest egg every year. I found that my numbers deviated in a hopeful manner from the studies ran with annual distributions assumed for simplicity. Keep being awesome. Mathematician1234 responded one more time in this conversation saying, interesting. Although I could use inflation-adjusted returns and then not need to modify the withdrawal for inflation, I think it makes it more difficult to explain to others. For example, if I do this in a spreadsheet and show it to my English major wife, she is not going to get it. It's just too clever. Yes, monthly rather than annual distributions will have some impact. That's certainly a more realistic approach. If it is a monthly instead of a beginning of year lump sum, then I think you will find you have a little more money invested during the year and a slightly better outcome. If it is monthly instead of an end year lump sum, then I think you will find you have a little less money invested during the year and slightly worse outcome. Your monthly simulation outcome is probably close to the average of the beginning and the end lump sum outcomes. I'm looking for a ballpark indication, so I will just likely stick to the annual for simplicity. And I respect that. We can definitely hit a point of diminishing returns by getting too detailed with our modeling for retirement. But I think there is, for me, for what I want to share with you, enough of a difference between annual and monthly modeling that it will impact the education that you take away from my work. And this conversation really got me wondering, is time varied inflation, actual historical inflation data, going to impact the results that I had shared with you back in episode 36, so much so that it would make a difference for your understanding of retirement? So over the last month, I have worked on rerunning my retirement modeling using the same set of historical data, but this time, instead of using a flat rate for assumed inflation raises year after year, I used historical inflation data. And I'm going to share those results with you now in today's main topic. For the main topic today, we're going to be going through my retirement study that was updated to use time-varied inflation as opposed to a flat assumed average rate for inflation raises. All right, a lot of big words, Jay. Do you have a visual to help with this? I certainly do. What we have here is a graph. On the x-axis, we have months for 3 years. So month 1 through month 36. Over here on the y-axis, I have what you're pulling out every month for your retirement income. Now you're going to see for 12 months, you're pulling the same amount out each month. And then for the beginning of the next year, you're going to be giving yourself a raise so that you have the same buying power you did last year. This is similar to getting a cost of living raise back when you were in the accumulation phase. Now, I think it's very realistic to assume that in retirement, you are going to give yourself a raise once a year. That's the way that most studies assume things working out. If you were to give yourself a monthly raise, well, that's what these yellow bars on this graph represent. If you're listening to audio only, what I have behind the green rectangles, there were 3 green rectangles representing 3 years, right? Now there's something that looks more like a staircase with yellow bars. And what interests me is if you give yourself a correction every month, you end up ultimately spending more money. You can think of each bar for each month representing how much money you're able to take out. If you add all the flat bars for 1 year, as opposed to adding all the staircase bars for the monthly inflation raises, the monthly inflation raises mean you take out more money over the long term. The increased spending you have mathematically is equal to the area of the triangle that is not overlapping with the green rectangles from the annual corrections for inflation. However, whether you're giving yourself a correction each month or each year, there is a problem. Both of these graphical representations here assume an annual inflation of 3%. It's an assumed value. Where did I get 3%?
Where'd you get that number?
Out of my butt.
So this leads us with a problem. If we pick a number for average inflation, be it what the Fed is targeting or what has been historically averaged, we're not going to be on point with what actual inflation is during our retirement. If our number ends up being higher than actual inflation over time, we run the risk of giving ourselves cost of living raises that outpace our investments, thus potentially increasing our risk of running out of money prematurely, even though we thought we made a good choice based off of a study. Conversely, if we give ourselves an annual raise based off of a number that ends up underneath actual inflation during our retirement, well, our survival statistics are probably going to be better than what we were working off of in our model when we came up with our strategy. And we might not be giving ourselves enough of a cost of living raise to maintain exact buying power. It's going to be much more accurate to use actual inflation as you're going. Now, the variation here might be minor. We're talking about, hey, I assumed 3%. And actual inflation during my retirement was 3.2%. Is it going to matter? Is it really going to make a difference? And as you think about that, I want to show you one more visual. I have some blue bars now that I've overlaid on top of the previous example. This blue graph that's on top shows actual historical inflation pulled from the year 2000 through 2003. This particular set of time ended up having inflation that exceeded the average for the first 2 years and then really slowed down in the last year. And in the end, the actual correction for inflation on a monthly basis exceeds the monthly income you wind up with at the end of year 3 if you're correcting for actual inflation month after month. So this represents both situations where you're not giving yourself enough of a cost of living raise for the first couple years, but over time, the actual average for real inflation was less than what you're correcting with. So if you were to extend this out 10, 20 years, you end up pulling out much more money. The TLDR is, in my initial study, I assumed 3% for inflation correction, which over time could deviate significantly from an actual inflation correction using historical inflation. And it ignores any correlation of the investment to time-varied inflation. And there's an outstanding question of, does it matter if I just give myself a flat number, say 3% in retirement, and I give myself a raise off of that, or do I have to look up what actual inflation is? I think it's going to depend on your time horizon largely, and we'll look at the statistics here in a minute. But I want you to think about something. If I use actual historical corrected data for inflation every single month, well, it's probably unrealistic that you're going to give yourself a raise every month. It's going to represent the worst case scenario. I would expect that if using historical inflation or actual inflation matters in retirement, you're going to probably still give yourself a raise once a year so that you're not driving yourself crazy every month looking up what was inflation and how much do I need to raise the bill and then changing the automatic withdrawal. No, that's something that you're more likely going to do once a year. And it's going to be a better case than if you gave yourself a correction every month. So the numbers I'm going to show you next assume a correction every month. And that is a worst case scenario if you are planning on giving yourself an annual inflation correction raise, which is why I didn't bother taking the actual inflation data this time and breaking it up into annual raises. I want you to understand that everything in the statistics I'm about ready to share with you was ran using a monthly correction, the blue graph. And you can use this information to inform you if you're going to use actual inflation data but only give yourself an income raise once a year. In fact, my numbers will be conservative if you interpret them and apply them to that sort of strategy. With that, let's dive into my statistical results. The tables up top are going to be the original results that I got from episode number 36. Meanwhile, the tables down here are going to be the ones that use the time-varied inflation assumptions, basically saying that you're going to either on an annual or monthly basis correct your withdrawal for actual inflation, as opposed to the 3% assumption in the table above. What we're going to do now is highlight the differences between the two studies. The first set of data that we're looking at is for a 20-year time horizon, and really the changes are minimal
Corporate needs you to find the differences between this picture and this picture.
You see the very thick black line on the graph differentiates the 95% plus statistical results that you're not going to run out of money, that you successfully retire, all the green boxes over here basically, from those that are less than 90% likely to succeed. And this bold line only changes in one cell in the study, basically adding a 5% safe withdrawal rate with a 90% stock and 10% bonds portfolio to the 95+% success. And then these double border lines separate the data from the 90+% to those that are less than 90%. So the bold line, 95% and above, the double border line is 90% and above. And if you compare the tables, you can see that with a tiny, tiny change in the statistics, we added 4 more cells, 4 more situations to the 90% plus success rate.
They're the same picture.
Now, these tables are assuming that you have a constant withdrawal rate. We're not using any financial guardrails at this point. I'll show those in a minute. The other table that I have, I'm not going to read through it all, but it shows the average value of your ending nest egg. The red cells are ones that end less than your initial investment. When I ran the numbers, I started with $1 million. It doesn't really matter what you start with because the survival statistics and the withdrawal rate are independent of the actual nest egg value. But the red cells are situations that I personally wouldn't end up using myself because it means that during the distribution phase, you ended up chewing into the nest egg and your buying power over time in your savings goes down. And the darker green cells over here are the ones that ended up growing the most. So if your goal in retirement is to leave the most to your heirs, well, you want something that's going to be more in the green area, something that grew and didn't end up getting eaten up. And if we compare the ending nest egg values between these two over 20 years, we see that there's about a 10 to 20% increase in nest egg value that you can leave to your heirs if you use actual historical data as opposed to an average inflation correction that exceeds what inflation actually is throughout your retirement. As the historical inflation for the data set I used was less than 3%, my inflation corrections were 3 under the original study. These next tables here are going to be for a 20-year time horizon that utilizes financial guardrails. I've explained financial guardrails before. Please go back to episode 36 if you want a little bit of a better explanation. In essence, what we're talking about here is if you were to have your nest egg corrected for inflation and it ever dropped below its initial buying power, you would default from whatever withdrawal rate you had before. Say you were using 5%, your nest egg drops below its initial $1 million, correcting for inflation. You then go to a 3% safe withdrawal rate until it recovers. You don't necessarily change your withdrawal rate depending on an up or down year. You're looking at the value of your nest egg over time and if it maintained its initial buying power. Likewise, you can take that value and say, if it grows at 12% under the original study without any withdraws, you just take that value and assume an average 12%. If your nest egg ever ends up above that, then you jump to an 8% safe withdrawal rate using Dave Ramsey's rule. In the new study, the second table is the one that was time value corrected. I dropped that upper limit, that upper bound, to 9% growth after inflation. All the data that I used in the second study was corrected for inflation month after month. So the bottom line was a flat 0. And the top line is going to be a 9% growth. So anytime the nest egg dropped below $1 million in value in today's money, we dropped the withdrawal rate to 3%, regardless of where we were on the graph before. And if it exceeded that 9% growth curve, I raised the withdrawal rate to 8%, saying basically you are someone who's very lucky in a market that's growing wildly well. You can afford to take out more if you want to. You don't have to, but that's where these results come from. And it doesn't take an expert to tell you that the survival rates for the 3% inflation assumption versus actual historical data are, I mean, there are differences between the numbers, but they're all like 97% likely to survive and above. Everything is green. It's boring.
They're the same picture.
And the ending nest egg values are still improved by about 10 to 20%, depending on the data that you're looking at. Let's go back to a situation where we're taking a flat percentage out through the entirety of retirement, but this time it's a 30-year time horizon. Well, the ending nest egg values all shift by somewhere around 30%. So you get much more money if you use historically accurate inflation corrections versus a flat number that's a bit more aggressive. If we look at the survival statistics, though, they change in an interesting way. Take a look at how steeply the 100% bonds drop off. We have at a 3.75% safe withdrawal rate, a 92.1% chance of success. At 4%, the 4% rule, we have an 80.5%. And then after that, 4.5% safe withdrawal rates drop it radically down to a 43.3% chance of success. And from there to a 5% safe withdrawal rate, we go to 14.1. Meanwhile, if we use time-varied inflation that's accurate for our cost of living raises, a 3.75% safe withdrawal rate results in a 97.5% success rate for an all-bond portfolio. The 4% rule is still above 90% success, 92.6. Before, remember, it was 80%. Then if we look at the 5% safe withdrawal rate, it is 33.9% likely to survive. Now, that's bad, but before I said it was 14.1. The odds of success doubled between using a flat 3% over 30 years for inflation correction as opposed to historically accurate data. And the same sort of thing happened with the more aggressive portfolios. Somewhere in the middle, it stays about the same. There's not too much that shifts around, but if you're very bond heavy or you're very equity heavy, the line which divides what is safe and what is not safe has shifted down a little bit. We see that in using my 401k, using the 3% inflation correction over 30 years results in nothing being safe, nothing being 95% or better with the success rate. But it's actually safe using accurate inflation data corrections for a 2.8% safe withdrawal rate. And it's almost 95% out of 3%. It's 94.5% likely. So you can see that on the edges of the graph, there's a bigger change for the boundary that separates what's safe and what's not. Given that mere fact, this is the takeaway that I want you to have. If you kind of tuned out while I was reading statistics numbers, I want you to focus in again and pay attention to this point. If you looked at some statistical data and made your decision off of a study that used a flat correction for cost of living raises year over year, and that flat correction is slightly more aggressive than the historical data that was used to model the study, you are looking at a number on the boundary that is conservative. And if you need to be near that boundary because you didn't save up enough to have a lower safe withdrawal rate where the difference doesn't matter, it can make a difference if you implement a strategy of actually looking at how inflation was this past year, correcting for it, and moving forward with that. Over the long run, it will be safer than a slightly too aggressive number that is not reflective of the unknown inflation you'll run into in the future. To drive this point home, I want us to look at the 50-year time horizon data results. If we use the 3% assumed inflation correction every year, the only situations that are safe, that meaning there's a 95% chance or better that you succeed, are going to be the 80-20 stock portfolio for a 3% safe withdrawal rate or less, a 50-50 stock bond portfolio for 3% safe withdrawal rate or less, or the 30 bond 70% stock portfolio for a 2.8% safe withdrawal rate. That's it. There are 5 cells that I would consider completely safe and comfortable engaging with, and they're very conservative portfolios using a flat but aggressive cost of living inflation correction year after year. Meanwhile, there are 11 situations using accurate inflation data corrections that are safe. It actually raises the highest safe withdrawal rate from 3% to 3.33% under the 80-20 and the 50-50 bond stock portfolio mixes. And I'd like to point out that the all stock strategy, the all stock portfolio, is now 96.2% likely to succeed if you're using a 2.8% safe withdrawal rate. Flat, no guardrails. This is opposed to up here when we're using the 3%. The all stock portfolio is 93.9% successful. So it was able to increase your success rate by 2 to 3%, shifting the bar, the boundary between what's safe and what's not safe. And as far as ending nest egg values after 50 years of the difference here, you'll see that the numbers down below, depending on the circumstance you're looking at, are around double of what they otherwise would have been. So being actually accurate with your inflation cost of living raises can double what you're leaving to your heirs if you have a very long time horizon in this particular comparison. And then there's the question of, well, does it make a difference with the financial guardrail results? And the answer is yes. In the financial guardrail results, with a 3% inflation cost of living correction year after year, there is only one situation. It's the 80% bond, 20% stock portfolio at a 3% safe withdrawal rate. That is the only situation that was safe under the original study results. Looking down here on the actual inflation accurate, everything in the 80-20% stock bond mix is safe. Everything under the 50-50 was safe. And almost everything on the 30% bond, 70% stock portfolio was safe. And the all bond portfolio went from being about a coin flip, a little bit better than a coin flip away from failing, to averaging over 80% across all safe withdrawal rates using actual time varied inflation corrections. Similarly, under this circumstance, my 401k in the original study had survival rates that varied between 77% and 83.1% of the time across the different safe withdrawal rates. But when we shift to using historical time varied inflation, as opposed to the flat 3%, the survival rate now varies from 83.7% all the way up to 88.2%. Basically, it increases your odds of survival in that instance by 5% across the board, with a little bit of variation. There's one more thing I want to point out for the differences, and I'm only going to reference the 30-year time horizon data, and that is what percentage of the time we end up spending at a 3% safe withdrawal rate when implementing a financial guardrail. So in the original study, we have the data again up top and the new inflation accurate time varied data down below. And what I see overall, I'm not going to read the numbers, but your amount of time where you are below your initial buying power in your nest egg and you're needing to use a very conservative safe withdrawal rate while your nest egg recovers is reduced by 3 to 7, maybe 8% of the time using most of the realistic portfolios in this strategy. And I'd encourage you, if you were really interested in letting how much time you're spending on the default safe withdrawal rate that you pick, the value that's over on the far side, as opposed to the 3% or the 8% safe withdrawal rate at the ceiling, pause the video, look at these graphs and kind of compare them, think through the results yourself. If you're listening to audio only, go find the video and check it out. I've got it all right here. One thing that's kind of crazy is that reduction in time at the floor seems to largely go to bumping up how much time is spent at the ceiling. Not all of it. A little bit sticks around at the default, about 1% or so, depending on where you're looking at the data. But hey, if I'm going to go from spending 1/3 of my retirement at a conservative safe withdrawal rate that's below what I'd expect to 1/4 of the time, which is the case here, I think that's worth it for me to not use a flat safe withdrawal rate correction for buying power. I think I want to make, personally, as a result of these differences, for me in my future, an inflation accurate correction year after year. I'm probably not going to do it month after month. That way I know that the numbers I'm using based off of this study to inform my retirement, and again, the results of these studies are only accurate to the point that the assumptions that I've implemented are healthy and good. They are not reflective of reality and the unknowns of the future, given that they're completely unknown. There's nothing this isn't a crystal ball here, is what I'm saying. But I am motivated to try to make inflation accurate corrections year after year. And if there's a year where I don't think I need to increase my buying power, if I really want to leave more money to my heirs, more money to my 2 sons and any children who follow, well, I might just not give myself a cost of living raise every once in a while. And that could also further improve how likely it is that I don't have to drop down to a conservative safe withdrawal rate during a downturn. Just let it grow up a little bit more. Be a little bit more flexible if I'm implementing a financial guardrail strategy in retirement. Okay, I want to ask you now, do these differences matter to you? The differences between A, just using a flat 3% to give yourself an inflation correction year after year, versus an inflation accurate correction year after year. Did it make a big enough difference in the results to influence the way that you think you want to manage your retirement, be it in the future or today? Additionally, is there a difference between the data sets of these two studies that I didn't mention, but it matters to you? You saw it and you said, this is important information, and this is going to influence the way that I understand retirement moving forward. I want to understand why it matters to you, and I would love for you to share it in the comments so that we can all learn and grow based off of these results and based off of what it is that you're seeing. There was a comment that led to the entirety of this episode coming to fruition, and the entire concept of me changing the way that I'm probably going to be running future updates to my retirement study. Your words, your stories, and what matters to you can change this show for the better to help all of us grow in knowledge and understanding for the good of our respective hope-filled financial futures. And while you're thinking about that, until next week, until next Tuesday, budget bravely and enjoy your hope-filled financial future.